Hello, and welcome to another in our series of video conversations, Dolfin Discussions. My name is James Gutman, and today I am talking with our good friend Caroline Miller. She is a chief strategist at BCA Research, and she has a wealth of experience in the financial markets. And what I'm very excited about today is an opportunity to pick Caroline's brain over the inflation outlook, particularly in the context of what's been going on over the past 6 months. I think where we go with inflation is probably one of the most important questions that we could be wrestling with at this time. So without any further ado, I'm just going to jump straight into it. Caroline, thank you again so much for joining us today.
A pleasure. Thank you for having me.
Well, I'm looking forward to it. Just to kick things off, so we have sort of a basis for the conversation. Can you very briefly just give me your outlook, the BCA perspective on inflation over the next months and years?
Sure. So I think over the next months, the impulse is certainly still disinflationary. The reopening of economies should not be conflated with overall recovery, and the fact is a huge output gap has been created. The massive rise in unemployment, I think the labor market is really the leading indicator of the fact that even on a second derivative basis, we're seeing somewhat of a bounce in the sentiment and activity indicators. But remember what that bounces off of, which is a coma. And we just talked before we started about the jobless claims in the US. There's still over 20 million people in the States seeking benefits, unemployed. And I think the initial phase of reopening will involve the rehiring of people who were just furloughed because of the shutdown logistically, but the long slog of recovery back to pre-pandemic levels of economic activity over the next 6 to 8 months is going to keep inflation quite low. I would say, though, that it may have troughed. Our longer term outlook, which I know we're going to discuss,
right,
is about an undiscounted revival of inflation. But I think that's really a 3-year story, not a 3-month one.
Okay, so near term, we're going to struggle with the output gap. It's going to keep the disinflationary pressure on prices. But you mentioned that long term reflation in prices that we might need to think about. So before we get into the longer term view, can we then take a step back and can we talk a little bit about what those key structural drivers might have been that have been driving the disinflationary pressures over the past decade? Because it has been quite tame on the inflationary front. So that gives us kind of a setup for why we think it might be different going forward.
Right. So structurally, I think there have been several trends driving a disinflationary outlook, even in the context of what we believe to have been a pretty robust economy before the pandemic. So the first is globalization of supply chains and the expansion of the global labor force to include, and of course this is from the perspective of developed economies like the G10, but the joining of China and many other Asian nations to the global labor force, really starting in 1980, but the accession to the WTO in 2000, I think, put meaningful disinflationary pressure on wage growth, which of course, back to my thesis that the labor market is the leading engine here. And not to mention foreign direct investment that optimized the procurement of supplies that are inputs to the production process. That was also globalized. And there's all kinds of evidence to show that that has been very flattering for profit margins, selling into the big consumer markets like the US and Europe, but has certainly kept global inflation tame. And we see the very high likelihood in this current environment of economic nationalism, the likelihood that the incremental pace of globalization, while it peaked 10 years ago, is certainly going to flatline, if not decline. And so that reverses one of those disinflationary trends. The other, of course, is tech, automation, the introduction of broadband internet, I mean, it kind of goes together with globalization. I think it's probably dangerous to try and predict the evolution of the tech impulse, but certainly we see in the productivity figures that the advent of mobile video, Snapchat, has had a less of an impact on productivity and reducing costs in the way we live and do business than the advent of the broadband internet and the proliferation of the use of technology in how people do business. That's been more important. So, you know, that's been a big driver. That may remain at the margin, but if you add it to the globalization piece, it may have peaked out. And then, of course, there's just the fact that demographics have been deflationary as well. You've had a proliferation of an accumulation of savings relative to investment. This may be getting too technical for listeners,
fine, it's good.
But it has, of course, kept the equilibrium rate of interest very low and caused it to decline, which means, and that's the rate of interest that is associated with full employment and price stability. If that equilibrium rate of interest is very low, then it means that it's very hard to have monetary policy be outright stimulative. You've got to push, and there's a limit to how much lower rates can go to become reflationary. We are there now for sure, but and maybe this is part of the conversation about where we're going forward, but we think that equilibrium rate of interest counterintuitively may be rising over time as the labor force growth slows and the ratio of people producing and saving relative to people who've retired and are just consuming changes the savings investment balance. That is going to lift the equilibrium rate of interest, which would mean that the current policy mix of very low rates is actually more stimulative. And that over a long period of time is likely to sow the seeds of a revival of inflation.
Okay, so you're starting to get into, you know, what I think is going to be a really important part of the conversation, which is the monetary impact on inflation. And, you know, full disclosure, I tend to fall into the camp of believing that inflation is fundamentally a monetary phenomenon. So that's sort of, it's not religion, but it sort of says something about how it's trained. But before we move there, I want to go back a little bit on globalization, because you talked about globalization as a driver for the disinflationary trends. And then we talked a little bit about the role of tech. So low labor costs in China, getting exported through Chinese goods into the US and other emerging markets, basically puts wage pressure via the goods mechanism into developed markets. So a couple things, though, have happened. I mean, first off, the Chinese wage rate has risen, absolutely, and relative to workers in the West. So that's kind of no longer as much of a disinflationary impulse. We're deglobalizing, as you correctly say, means that we're not going to be able to import those disinflationary pressures. But there's also the service sector as a rising share of GDP, of output. So I think it's a lot harder to globalize service sector disinflationary trends versus goods and products. Am I wrong about this? I mean, is this service sector not really relevant to thinking about the globalization of inflation?
I think it's always been relevant, but people still need TVs, computers, shoes, furniture, textiles. And so I think the greater focus in terms of goods inflation or disinflation has to be on manufacturing pricing power. And as far as the service sector, it's more labor intensive, tends to be less trade oriented, and in fact is a pure read. If you look at service sector inflation in the US, for example, it's a pure read on domestic economic slack. And right now, certainly there's disinflationary pressure building there from the very weak labor market. But if you want to be technical about how you define service price inflation, it includes healthcare, it includes education, it includes shelter, and there's certainly that the pandemic is having a big impact on all three of those. But I just also want to distinguish, I think, between just the bilateral U.S.-China relationship and how much that is unraveling, shall we say, and we shouldn't conflate the reduction in focus and dependence on that unique supply chain with the fact that, I think diversification of supply chains isn't the same thing as a complete retreat inward. So what I'm saying is I don't think that television sets are all of a sudden going to be manufactured in Indiana. I think where you're going to see the retreat from trade is in areas that are sensitive relative to a country's sense of preparedness and resilience and self-sufficiency, certainly in areas of cybersecurity and healthcare. I don't think it will make sense, and I don't think that economically rational corporate actors are going to completely eschew sourcing inputs to manufacturing globally. I think there'll be just a shift maybe to other suppliers. But from a service perspective, there's still big swathes of what people spend money on services on a day-to-day basis that don't lend themselves to trade. So
I don't want to spend too much of our time here because I really want to dig into monetary policy. Yep. But just going to hammer at this just really, really briefly. Is it possible to imagine a scenario where just as manufactured products coming out of Southeast Asia and China exhibited in disinflationary impulses in the 2000 and 2010s, online doctors, online education, you can't get a haircut from India, but you can certainly call, be in touch with a call center, that's outside of the U.S. or outside of Western Europe. So is that sort of a wild card replacement, particularly now that we're all doing all of our conversations on Zoom?
Yeah, I think it is. I think, though, that rather than being disinflationary for the cost of healthcare, I think it is going to change the way it is delivered. But if you look at total healthcare spending in a lot of the developing world, it's very low as a share of GDP. So I would expect demand to be rising considerably, and that's another factor that is not necessarily globally disinflationary for healthcare spending overall and demand for services. If you look at the wholesale cost of healthcare in the U.S. relative to wholesale inflation in general, it is still rising, and healthcare has been one of the sectors that has persistent pricing power. So I think rather than pushing down the total cost or total spend on healthcare, we're going to hopefully increase access to services via telemedicine. Absolutely.
Yeah, it's interesting. I mean, I think at some point we'll have to have another conversation about that, because one of the things that I sort of like to sort of describe to people is that in a perfect world, we would have to spend very little on things like shoes and cars because they would be so efficient, and instead we would be spending all of our money on extremely personalized delivery of healthcare and of education, things which which really we have kind of infinite demand for. But I do want to get back to money supply. So if it's okay, can we talk about the relationship between money supply and inflation? I mean, once upon a time, Friedman had kind of, established that there was this direct relationship between, growth in money and growth and change in prices. And I always found that to be a very, very convincing argument. And then I was completely and utterly wrong in the aftermath of the global financial crisis, when I thought we're looking at another episode of money dying, and yet we didn't. Despite QE, despite record low inflation, interest rates, disinflation just persisted. So we're looking at sort of an unprecedented, truly unprecedented surge of liquidity across the board. Is this not going to be the single most important driver for that reflationary trend?
I think it will be eventually. The missing piece between money supply and inflation is the velocity of money,
Right.
which really collapsed in the aftermath of the financial crisis. So credit growth, in layman's terms, how quickly does that money supply become, rekindle economic growth?
Right.
I think in the 2010s, I guess we have to talk about that decade is discrete now because we're in 2020. We did see a lot of money supply expansion get trapped in the banking system. In other words, there was a collapse in the demand for credit. And
the velocity of money was restrained because the liquidity was injected into the banks, but the banks did not pass it through to businesses and consumers.
But that's because there was no demand for credit, because private sector deleveraging was a fairly savage, ubiquitous trend. And this is what I think is distinct in this current episode. You also had what I think now is perceived to have been a mistake, which was the premature withdrawal of fiscal stimulus. So you had, if you will, public sector deleveraging still happening in the context of private sector deleveraging, and that accelerated the decline in the velocity of money, which of course a lot of the net stimulus from the financial crisis was monetary, trapped in the banking system. Now what you're seeing is a much more permissive, aggressive approach to fiscal stimulus as a means of alleviating hardship. And so you're directly injecting a lot of this money supply into the veins of the real economy in a way that didn't happen in 2008, 2009. And so I think really the pivot point, though, for when this stimulus becomes inflationary, again, back to the labor market, has to be once the economy is healed. Right now, you still see, we see it particularly in China, which reopened sooner than North America, but actually the new governor of the Central Bank of Canada highlighted this last week in his first communique. You're seeing supply recover faster than demand. So people are going back to work, industrial capacity is rising, retail sales still very depressed. And so I think until you get some revival of the velocity of money, the money supply is sort of dry powder, is a coiled spring. And so really the conversation needs to narrow back to how long is that runway of economic recovery, and where is the state of money supply growth once that kind of cruising altitude is achieved again. And I think it's a multi-year process, not a few months.
So what about the central banks, or the Fed in particular, directly intervening and directly purchasing securities, which is something that we're seeing now? I mean, it's very much on the table in the credit market. And,
yes.
In the process of responding to this question, if you wanted to give me your odds on the Fed stepping in and buying equities, I'd be curious to hear about that as well. Does that sort of bypassing of the banking system mean that it will be easier for money supply to start to accelerate in velocity terms once demand starts to pick up?
Well, let me answer the equity question first
Sure.
directly, which is that would be in direct contravention to the Federal Reserve Act. I think the Fed has been asked squarely, and in the same way that they have telegraphed to markets that moving to negative interest rates is at the bottom of the list of policy tools, I think buying equities is right down there as well in terms of likelihood, very low. I think the monetary intervention to date has achieved, a few milestones, again, using the financial crisis as a roadmap or point of comparison. What you are seeing is that the velocity of money isn't collapsing incrementally from current low levels, which is something we should be thankful for. You're seeing that as a result of the Fed's intervention, many firms have been able to raise capital. Investment grade firms have issued a ton of debt.
Mm.
Not only that, spreads in some of the key funding markets have come down such that credit is still flowing to the private sector. And you haven't seen the collapse in demand in the real economy lead to a severe credit crunch yet. So I think that is how I would measure the success of these programs. And if you look at the bonds, the sheer stock of bonds that the Fed has actually been buying, it's nickels on the dollar of the outstanding size of the market. The power of the forward guidance of the intention and willingness to deploy that policy has been very effective. And so that speaks to still the utility of forward guidance and the belief that if the Fed wants to medicate pain in liquidity markets, it can, I think has been very powerful. I want to distinguish between that though, and looking across the valley of defaults and assuming that we've lost all price discovery in credit markets. I don't believe that's the case. If you look at the outlook for defaults and distress in the single B and lower credit tiers, that is outside the Fed's firewall, their goal has been to prevent wide-scale insolvency among firms that, but for the pandemic, were going concerns and had reasonable balance sheets. And so that's why they have included the double B sector, so the potential fallen angels, in their safety net. Right. Everything outside of there, you are absolutely going to see more defaults and a lower recovery rate in there. And we believe that markets have conflated the protection, the regulatory protection in the higher credit tiers too far out. And you know, we see likelihood still of some distress in those weaker funding markets. But the Fed has succeeded in retaining the flow of credit to the private sector. That's probably their biggest achievement in terms of the ripple effects on markets and ultimately demand in the economy to date. I believe that's been the right call, but it's not going to result, it's not going to prove, all it's doing is putting a floor under prices. It is not going to result in an immediate impulse towards inflation again until you see more healing in the underlying aggregate demand.
Yeah, I mean, I think one of the things that I'm a little bit worried here, that worries me about this Fed response to credit conditions is the risk that you end up with Japanese-style zombie companies who sort of exist in order to borrow more money at artificially low rates, which they can then use to service their pre-existing debts, and it just becomes this kind of balloon that keeps filling up with ever more of that liquidity, which should be going to productive activities, but instead is just being used to keep people or to keep a company from disappearing. And I take your point about how the Fed has tried to distinguish between those companies which were a going concern pre-pandemic versus post-pandemic. But at the end of the day, I mean, the pandemic is a fact. It is a shock. If there's a war in the Middle East or an oil embargo coming out of the Middle East, it's also a fact. You can't accommodate every shock. At some point, you have to let prices fall or rise accordingly. And so as time passes, I just wonder if there isn't a risk that the Fed backstop on previously viable companies then becomes the Fed guarantee for zombies that maybe they were viable once, but sorry guys, that doesn't work anymore. And now you're just bloated with capital which could be allocated elsewhere into the economy for productive purposes.
So I think that's a risk. The counterfactual, though, would have been a far more pernicious dynamic of seizure of the banking system more immediately that would have been more difficult to control. I don't believe the Fed, and that's where critics of policy, I think, are fair to highlight risks, but unless you're proposing a more viable alternative that is going to be, is going to hew better to the long-term, near-term and long-term welfare of the Fed's basic mandate, which is full employment and price stability. To quote Churchill, capitalism is the worst possible system except for all the others.
Right. I think he said that about
Not as though,
democracy too. And yeah.
but so I want to distinguish. I think the Fed has been managing a liquidity shock. They aren't going to be able to prevent a credit shock. And so if the recovery does not proceed in a V-shaped fashion over time, you will have firms that are downgraded to double B that, because the rating agency's objective lens on balance sheet, so leverage, liquidity, profitability will remain constant, and firms will be compared rating tier by rating tier to those metrics. And so all the Fed can do is provide a bridge over this period of such a sharp chasm in demand. But as the economy reopens, I think there's going to be more scrutiny and more dispersion among firms' credit quality, and they can't prevent downgrades. And then once firms go from double B below there, you get this geometric increase in default risk that I don't see the Fed expecting to indemnify. And so just as investment grade firms typically aren't the focus of defaults, I do think you're going to see a savage default cycle. And so that zombie phenomenon has, yes, been obscured and been given a lifeline over the near term. But over the long term, I would expect the macro fundamentals of aggregate demand in the economy to drive firms that are able to hold their breath underwater just long enough. You get the economy recovering, and they either adapt and survive, or they don't. And so all the Fed has done is maybe smooth out some of that vol, but they will not be saving everybody. And there will be a cleansing process. And basically, actually, the allowance of firms to issue a lot of debt has actually been the flip side of the Fed not having to provide more direct support in the form of buying equity.
Sure.
By version of that forward guidance, firms firms have pursued other avenues of sustaining liquidity in the near term. But again, it's going to be how quickly do we return to trend growth? And to the extent that that is hampered either by perceptions of public health still being a risk, even if economies are reopened, people are still keeping their distance. And many firms, many service firms, back to the question of services versus goods. I mean, I see that here where I live. A restaurant that has a capacity for 30 and is profitable at 27, and now is being told you can reopen, but you can only have 15 people. Not so much. So I still think there's many headwinds to recovery, and the Fed looks as though they have really medicated the problem. Parts of it are just palliative, not curative, and I think we're going to see that the second round effects of risk of insolvency, come into sharper focus. But I don't think you can blame them for doing what they can to try to prevent a tsunami right away.
For sure. And before I don't even want to waste more breath than is necessary. And then on that front, I think the Fed did exactly the right thing. I think the worst case scenario is to have the patient die on the operating table. So first, keep the patient alive. Then, if the surgery and the post-operative care proves to be painful and long-term, that's the price of living. And I think that the Fed did absolutely the right thing. It does, but listening to you, it does suggest to me like what's happened here is the Fed has sort of dulled some of the short-term blow and sort of shifted some of that pain out into future quarters, which seems like the reasonable thing to do. There is a credibility issue here. Markets need to believe that the Fed can resist political influence and can maintain, can turn into the hard choice maker, can be the bad guy, particularly come, I don't know, maybe November, or in the first term of whoever we'll see in the White House. That might be difficult. I mean, there's politicization of the Fed has kind of become an issue. I don't want to go down that rabbit hole because I very quickly wanted to get to a couple other points, and I know that our time with you is somewhat limited. Energy prices. What do we think? So energy had some very dramatic moves with the negative price and the negative contango early in March. But no matter how you look at it, oil prices are lower, just really substantially lower. And that's a demand-driven phenomenon, not a supply phenomenon here. Is this going to be important for the disinflationary pressures looking forward? How do we see energy as figuring into the inflationary outlook?
So first, I would say that conceptually, spot price of energy should not impact long-term market-based inflation expectations, because the presumption should be that the job of a central bank is to counter moves in resource prices to maintain price stability. There is an asymmetry in that reaction function and perceived credibility when rates are at zero, i.e. when you get a big negative demand shock that pushes resource prices down, there's a concern that there's not that much the central bank can do about it with rates already at rock bottom levels. And so what you get is an increased sensitivity of inflation expectations, which do ultimately feed into actual inflation, to the downside. What we think is that, in fact, energy prices have bottomed. Yes, there's been a demand shock. We now see a big supply shock coming, i.e. production restraint. Not just production restraint. You look at the rig count in the US, it's down at 2009 levels. Yeah. You look at OPEC and then other countries outside OPEC, none of them breathe fiscally at $30 oil, even really at $40 oil, to be honest. And so we see the peak of global inventories and the current glut of supply being reduced over the balance of this year as production management really becomes a big driver, and in the context of expectations of some recovery in demand. But the upshot is that if we've seen the low in commodity prices, then we've seen probably the end of the near-term disinflationary pressure from that sector on overall inflation. And at the margin, we should see some reflationary tailwind from the gradual recovery of commodity prices over the next 12 to 18 months.
But do commodity prices even matter anymore? I mean, this is in the 70s. Oil counted for a lot back.
Yeah. I think they still matter at the margin for inflation expectations, and in economics, everything is about the second derivative. If oil didn't matter anymore, then the decline, you wouldn't see the tips and actual inflation and headline inflation still being so linked on the downside. How can it be that they don't matter on the downside, but that they do matter on the upside? I think there's still symmetry to the relevance of the general direction of commodity prices, although I would admit that the global economy is less energy intensive in the developed world. I think if you look at China, for example, or many other countries that are still increasing industrialization, energy is still important as an input. And our commodities team sees oil averaging around $40 through the end of this year and moving up into the low 60s next year again, because of the expectation of a big shift in supply. And I would add, it isn't just pumping less today, but less credit, less capital flowing to the sector means, and markets are forward discounting mechanisms, less increase in productive capacity on a go-forward basis at a time when you would expect over the next couple of years that demand will be recovering. And so that is the mix that we believe sows the seeds of some recovery in oil. We're not talking $100, and we're not talking 70s style inflation. And I think, we're going to get to what sectors, but look at what is discounted. The 10-year TIPS break-even inflation yield at the US at 1.3%. That's a very low bar in terms of inflation. I can't imagine with the combination of fiscal monetary policy where it is, with the presumption that the economy has troughed and we are going to see a recovery, that inflation is going to average 1.3. And I should have added, you mentioned central bank credibility. A big force in the disinflationary vibe over the last several decades has been central bank independence and central bank credibility. As opposed to being a fiscal agent of the government, they really, central banks starting with Volcker became independent trustees of price stability. I fear that's what this going into the political area, but I absolutely think that we could see a reversal in that dynamic over the next 10 years.
It's something that keeps me up at night. For the moment, it does feel like certainly the Fed is trying very hard to navigate those rocks, and so far seems to be doing a reasonably good job. We'll see what coming quarters and years have to say. But I mean, for sure, central bank credibility worries me. Okay, so demand shock, or I'm sorry, the demand side of the economy creating disinflationary pressures over coming months and quarters, but longer term, we think that the inflationary pressures resume, partly because of the unwind of some of those structural issues that had been disinflationary, partly because of just the pressure of demand recovery, and aided and abetted by ample liquidity out there and so forth. And first question that I want to ask you then is, what assets do I want to own? So in an inflationary environment, particularly in an inflationary environment in the 21st century, what assets and what sectors look attractive?
Right now, as I quickly mentioned, the TIPS market, not just in the US, but if you look at the fair value of inflation-linked bonds in all the G7 markets that issue these securities, they're anywhere from 30 to 50 basis points cheap to a regression of actual realized inflation. So this goes back to that the recency bias of investors believing inflation is dead forever. That is where we see critical value now. I think gold has been that safe haven, has done well, but over several years, I think it's still a structural important hedging tool in portfolios. In terms of equity sectors, we've actually looked at 6 periods of disinflation, deflation, disinflation since the mid-60s, and looked at the performance of various equity sectors over each of those. And very clearly, healthcare, energy, real estate, and materials tend to do well in periods of rising inflation. Tech, utilities, and telecom services are always the underperformers. But I want to stress that structurally positioning a portfolio with those bets right now isn't necessarily going to pay. I think those are 3 to 5
years. A bit early.
Beg your pardon?
It's a bit early for that.
It's definitely a bit early. Yes. But it's not early. It's not early to buy TIPS, because we believe that while central banks are absolutely not going to tighten anytime soon, as the economy recovers, that will manifest in some recovery of inflation expectations, and so TIPS should outperform nominal bonds. That's probably a near-term play, but longer term, the consistent performance of equity sectors on a relative basis hews to those 2 groups: pricing power in energy, healthcare, real estate, materials, and underperformance of the bond proxies, so utilities, telecom. Typically, of course, because you would expect that as inflation starts to rise structurally, bond yields will rise. Those couple sectors have done really well as interest rates have become less attractive. Tech has deflation built into its business model. Just think about it conceptually. Every new gadget and toy you buy starts to lose value the minute you own it, and so tech is going to perform better in a disinflationary environment, which we have seen over the last 2-3 decades. Probably going to lag as pricing power recovers in real manufactured goods.
So, very, very quickly, should we be careful about making that sort of a long-term projection or medium-term projection? How's that with respect to tech? Because I mean, there is something very structural with. I mean, you say every new gadget. I mean, it's not really the fact that I'm getting a new iPhone because we've just learned how to talk to each other at a distance. It's I'm getting this new really cool technology that lets me interact with data at a distance in a way that I wasn't able to do 20 years ago or 50 years ago. I mean, I remember at University of Chicago, I was an early adopter of email because that's where I was in 1990. And now that sort of trend has kind of worked its way through. there isn't an infinite amount of usefulness from ever expanding capacity to data and computer processing. So maybe we're going to get to the point where that disinflationary impact from tech just kind of levels off. So maybe tech doesn't have that factor.
It indeed has sales and profit resilience connected to innovation that by definition I think is difficult to forecast. But from a tactical perspective, I still think that the outperformance is going to come from the real assets. And tech is a structural thing that you want to own in portfolios. There are other reasons that it had performed well in disinflationary environments. It's a long duration asset. Cash flow growth in the tech sector is very sensitive to the discount rate, which of course has been dropping precipitously. It'll be interesting to see the relative performance of tech from a valuation multiple dynamic if indeed rates can no longer drop much more. Again, we're talking relative performance tech versus other sectors.
Sure. Okay, I get that. That makes a lot of sense. Last sort of big question, and it's the last question, and I suppose the biggest for the best, and the best for the last. The path to policy normalization. Every time I get in front of a client, every time I write something for our clients, I find myself having to use the phrase unprecedented. And it really is unprecedented. Like things which 20 years ago, I gave a 0.001% likelihood. Maybe in 2008-9, it went up to a 5% likelihood. Now have happened. Not least of which is this enormous expansion of central bank balance sheets, which is the complement, I wonder, to the enormous increase in fiscal debt on the public sector debt. So how do we renormalize? And what does renormalizing look like? Like what is going to be that new policy normal in the years to come?
So I think we're only going to get the answer to that question again when we're much closer to the output gap being closed. So it's not going to be fair to say that the Fed has left policy too loose for too long until we see that we've got a recovery of pricing power in the economy. That'll be the moment of truth as to whether central banks have been completely neutered. I believe there will be a lot of political pressure to sustain forbearance on normalizing rates. And that'll be because, as you say, we've had on the one hand, significant easing in financial conditions, which allows at the moment a big rise in public sector debt with no incremental impact on the debt service burden. That is—
Interest rates are so low.
That's right. Italy's a perfect example. We looked at this closely. They can increase their public sector debt to GDP ratio by 20 percentage points and barely move the needle on, there's no risk of servicing that debt crowding out total government spending. That symbiotic, serendipitous state of affairs will come to an end when the economy has reached full employment. The public sector debt level will be very high. It'll certainly be time to roll back that stimulus. However, the risk will be at that point, raising rates with a much higher debt burden will cause an increase in the debt service burden. And so I think as you imagine, how does a government address a large debt burden? Ideally, you grow your way out of it, right? You have productivity and labor force, which are the components of trend growth. I think that's unlikely. Demographics are the least controversial, most forecastable variable in the macro world, and we're heading to a world of more consumption, less production, as people age. Productivity is notoriously difficult to forecast, but can't bank on it taking off. So that sort of passive lucky out is probably off the table. You can restructure your way out of it, which is political suicide. We're not going to see a default on US Treasuries. you can tax your way out of it here. I really think that's unlikely. We're seeing not just a public health crisis, not just an economic crisis, certainly in the US, a social crisis that is for sure partly the upshot of growing inequality of income and opportunity. And so I think you're going to see big government income redistributive policies remain in place. And so the only other option then is to tacitly allow inflation to rise, reducing the real value of that debt burden. And the path to that is not raising rates and reducing government subsidies, even when the economy no longer needs them. And if that isn't inflationary, I don't know what is. So
it's funny. It's almost like one of the bricks that you can put into an inflation, a forecast for higher inflation, is that it's the least painful way for governments to get out of the hole that they find themselves in. So
that they will find themselves in. They're not in that hole now, but they will.
Well, I think it's kind of I agree, but I mean, it's sort of like the car is driven off the cliff.
Yeah.
The forecast is that it will fall down into the hole. I mean, it's pretty clear in my mind. So in some ways, the central bank central banks allowing inflation to accelerate is sort of the least painful way of getting out of this debt burden, which begs the question that central banks will be successful, that all of these things will happen. But it's kind of almost the most hopeful possible scenario. And it's funny you should say that, because that underpins a lot of my view on what this looks like going forward. But I guess before we go, I just want to press you a little bit on this point, because at some stage there will need to be some kind of a rollback in the extent of fiscal stimulus. I mean, I think last time I added up the numbers this year in 2020, cyclically adjusted fiscal stimulus adds 4 percentage points to global GDP. Well, you can't repeat that trick next year unless you really see budgets absolutely skyrocket. I mean, even just holding steady is going to feel like a 4 percentage point drag to global GDP. And that's globally. That's not just restricted to specific markets. So the sort of deceleration or even reversal on the fiscal side, once you start to see the signs of that labor market, that output slack being reduced, that's going to feel like a blow to the gut. And then if on the other side, you've got central banks trying to manage their liquidity and their balance sheet so as to avoid things getting too toppy, it's also going to feel like a blow. So you have this sort of perverse kind of environment where you want to let the global, or you want to let economies kind of overheat a little bit. You want to let them sort of have a bit more inflation than you would normally have, so that you don't bankrupt the public sector. But at the same time, you need to manage how much slack you allow them, or how much rope you give on the monetary side. Because if it gets out of, every time you try to pull back a little bit, it's gonna push you right back into the hole because of how dependent we are on these stimulus methods. So that path to me, and I know this is a very long-winded and rambly sort of comment, that path to me strikes me as extremely fraught. I don't know that policymakers have been that nimble in, I don't know, like, I don't have any evidence for them being able to pull off that kind of a hat trick so well.
So I think on the fiscal side, it becoming obvious that benefits are no longer needed is a high quality problem. And my concern is actually the risk is still that fiscal support will be withdrawn too soon rather than extend. Just the end of July in the US, the exceptional unemployment benefits are due to expire. As you say, that's a big fiscal cliff for the US, particularly in the state and local government level. So I think they will inevitably be extended, particularly in an election year. I worry less from the monetary side. I think when you get again, the Fed keeps reminding you, full employment, price stability. As long as you're not at 2% core inflation and the unemployment rate is double digits, then, that's their cover to keep pedal to the metal. And I think they can continue to do that given how much torque they've gotten from forward guidance to date. If you look at what they've really actually, the intervention in the actual markets, it hasn't been that enormous relative to the perceived power.
They got it for free.
Yeah, exactly.
I think you said 5 cents on the dollar. That's about right. Like they hardly spent a dime.
So I worry less that the Fed doesn't have the ability to pull back when the real economy demonstrates less of a need. I think on the fiscal side, however, the political pressure to really address root inequality is going to mean that big government is with us for many more years. And I think it's very clear from the post financial crisis period, the European sovereign debt crisis was a direct result of moving to fiscal austerity too soon. So I believe those will be high quality problems. And in the near term, we ought to really consider the counterfactual of not having that policy support on what life would look like for consumers and businesses. And with rates where they are right now, this is still the right policy mix. And again, when we get to that fork in the road where the economy, where we've reached something close to full employment, then I think you can have a conversation about the relevance of too much fiscal intervention. But I don't think I don't think that clash is likely in the next 2 to 3 years, frankly.
I was going to say, can you give me just as a final question? Can you give me a guesstimate as to when you think that full employment starts to once again be an issue?
3 years.
Okay, 3 years. I'm going to write that down. We're gonna have a cat in 3 years. Hopefully, I hope you're wrong.
Before then, maybe.
I hope it. Couldn't be soon enough. Caroline Miller, thank you very much. Really been absolutely fascinating. And I'm very grateful for you taking the time to walk through these questions. Couldn't be more important right now as far as thinking about how we're going to deploy client assets over the coming months, quarters, and years. So again, I really appreciate it. Thank you very much.
My pleasure. Thanks for having me. Have a great day. Bye-bye.
And thank you to all of our friends and clients who have taken the time out of their busy schedules to watch this video. I hope it was useful. So I wanted to let you know that we have some upcoming videos that we're excited about. We'll be having a conversation about emerging market debt opportunities. And I will also be doing another one in the weeks to come on the road ahead for electric vehicles. So these are some exciting topics that I hope you'll tune into and get some interest out of. If you have any questions, you can always feel free to reach out to me directly, or you can send an email to marketing@dolfin.com. And we always invite you to go to our website, dolfin.com/research, where we have links to other videos and some of our written work as well. Again, thank you very much, and look forward to having you join us for one of our future conversations.